You have probably not flown Delta this year. There's a real chance you have paid Delta anyway, every single month, without ever once sitting in one of its seats. Think about the last time you filled up your car or grabbed groceries or paid a phone bill and happened to use a card with an airline's logo stamped on the front. In that moment, sitting in a parking lot or standing at a checkout counter, nowhere near an airport, you were quietly making that airline money. Not a lot, from any single swipe. But multiply that by tens of millions of cardholders doing exactly the same ordinary thing on an ordinary Tuesday that has nothing to do with travel, and you start to see the outline of a business almost nobody boards a plane thinking about. That sentence sounds like a trick. It isn't. It's just how a surprising number of major airlines actually make their money now, and almost none of them advertise it, because the honest version of the pitch would sound less like a vacation and more like a confession. Somewhere inside every big airline in America, there are two completely different businesses wearing the same uniform. One of them owns airplanes, burns fuel, pays pilots, and loses money more often than most passengers would ever guess. The other one owns almost nothing you can touch, and it is, in a lot of years, the only reason the first one survives. Neither business advertises itself honestly to the customer standing at the gate. The pitch at the gate is about a destination. A seat, a vacation. The pitch happening quietly in the background, the one running through a bank's own investor presentations, is about something else entirely. A captive, high-spending customer base, and a fee collected every time the customer buys almost anything at all. Start with the business you already know, the one printed on your boarding pass. Flying passengers around the country is, and has more or less always been, a brutal way to make a living. Fuel costs swing wildly with oil prices the airline has no control over. Labor is heavily unionized and expensive, for good reason, since the job involves other people's safety at 35,000 feet. Airplanes cost hundreds of millions of dollars apiece and need to fly nearly constantly to be worth owning at all. Add a downturn, a fuel spike, or a global health crisis, and margins that were thin to begin with can vanish entirely within a single quarter. The airline industry has spent decades as one of the worst long-term investments in the entire stock market, a business famous enough for destroying capital that Warren Buffett once joked an investor could have done the world a favor by shooting down the Wright brothers over Kitty Hawk. That is the business printed in giant letters on the plane's fuselage. It is not, for a lot of these companies, the business quietly keeping the whole operation solvent. The second business does not have a name painted on anything. It lives inside a loyalty program most passengers think of as a rewards app, the place where miles pile up and occasionally turn into a free upgrade. Legally and financially, that loyalty program increasingly behaves less like a customer perk and more like its own separate financial company, one that happens to share office space, a logo, and a frequent flyer number with an airline. Some of these programs have even been reorganized quietly into their own distinct corporate subsidiaries with their own separate books, their own separate contracts, and their own separate ability to borrow money against future cash flow entirely apart from the airline whose name sits on the outside of the plane. Here's the part that should genuinely change how you think about that mileage app on your phone. When you swipe a co-branded airline credit card at the grocery store, the airline does not actually give you a mile out of the goodness of its rewards program. The bank issuing that card buys the mile from the airline in cash up front the same way a company buys inventory before it sells it. Every time a cardholder earns a mile, the airline has already been paid for that mile by the bank, well before you ever redeem it for a seat. The mile in your account is not a gift, it is a receipt. A receipt for a transaction that already happened between two much larger companies, one of which is an airline, and one of which is not. This isn't a recent trick either. Delta and American Express extended their credit card partnership back in 2008, and as part of that single agreement, American Express handed Delta an immediate cash payment of roughly $1 billion simply for the right to keep selling Delta SkyMiles to its own cardholders, with another billion promised over the following years as the deal expanded. Read the actual language from that agreement, and it says exactly what it sounds like. A purchase of SkyMiles. Not a marketing partnership. A purchase. Delta was selling something in bulk years before most of its own passengers understood that miles were a product with a price tag rather than a loyalty gesture. The airline's own accounting confirms it, if you know where to look. When an airline sells a mile to a bank, it cannot simply book that cash as profit the moment it arrives, because the airline still owes something in return. A future seat, an upgrade, some form of travel eventually redeemed. Accountants call this deferred revenue, a liability sitting on the balance sheet representing everything the airline has already been paid for but hasn't yet delivered. Airlines carry billions of dollars of exactly this kind of liability tied to outstanding miles, a number that functions almost like a layaway plan running at the scale of an entire company, cash collected today against a seat that might not get used for a decade, if it ever gets used at all. Every mile that expires unused, every account abandoned by someone who stopped flying that airline years ago, quietly converts that liability into pure, uncontested profit. Without the airline ever having to hand over a single seat in exchange, think about how strange that is for a moment. An airline can profit more from a mile you forget about than from a mile you actually redeem. The forgetting is not a loss to the business. It is the business working exactly as intended. Look at the actual numbers because they stop being an abstraction fast. Delta's partnership with American Express began back in 1996. By 2025, it had grown into something worth roughly $8 billion, close to 10% of the airline's entire revenue coming from a credit card partnership rather than a single seat sold. Delta's own chief executive has said publicly that spending on Delta's co-branded American Express cards is approaching 1% of the entire gross domestic product of the United States. Sit with that for a second. 1% of the entire American economy flowing through cards branded with a single airline's logo, most of it spent on things that have nothing to do with flying at all. Company leadership has reportedly set an internal target of pushing that credit card revenue figure toward $10 billion over the long run, a number that would make the card business alone worth more than entire airlines many passengers have actually flown on. Across the industry more broadly, one widely cited estimate puts more than half of all frequent flyer miles issued in the United States as coming from credit card spending rather than actual flying. The average mile in the average account was never really earned in an airplane seat at all. It was earned at a gas station, a grocery store, or a restaurant using a card with an airline's logo on the front and a bank's balance sheet behind it. Banks are willing to pay handsomely for this arrangement, and the reason is simple. The type of person who applies for an airline credit card is, statistically, an extremely attractive customer to have on the books. Someone chasing travel rewards tends to have strong credit, a higher-than-average income, and a habit of putting large, recurring purchases onto a single card instead of spreading them across several. Steady interchange revenue. Comparatively low default risk. Exactly what a bank wants. That is precisely why the annual fees on these cards have been climbing so aggressively in recent years, even as the core benefits stay roughly the same. One popular premium travel card jumped from $550 a year to nearly $800, a jump of more than 40%, while a major competitor's flagship card is expected to cross $750 annually. Cardholders have largely kept signing up anyway. Banks can charge that much because the travel perks attached, the lounge access, the companion certificates, the miles themselves are subsidized by an economic engine that has nothing to do with the cost of actually printing a plastic card or answering a customer service call. The airline gets its cut. The bank gets a low-risk, high-spending customer, the only party in that arrangement who has to keep swiping and keep paying an annual fee that climbs a little higher every year is you. This is why the interchange fee, the small percentage a bank collects every time that card gets swiped anywhere in the world, matters so much more to an airline than most passengers ever realize. Merchants typically pay somewhere between 1.5% and 3.5% of every transaction back to the card network, and issuing bank and premium travel rewards cards tend to sit at the higher end of that range. A slice of that fee flows back to the airline every time a cardholder buys coffee, gas, or groceries, whether or not that person has boarded a plane in months. The airline gets paid a small amount every time one of its cardholders lives an ordinary life, completely disconnected from whether that person ever flies again. Now put a single comparison next to that, because it is the cleanest way to see how lopsided this has become. Industry research on the top 6 American airlines has found that their credit card and loyalty partnerships represent more than 5% of their combined total revenue. That sounds modest until you compare it against net profit instead of revenue. Measured against actual bottom-line profit, those loyalty and card partnerships add up to roughly 5 times the airline's entire net income. 5 times. Not a nice bonus sitting on top of an already profitable airline. In a lot of these companies, essentially the entire profit, and then some, propped up by a credit card business large enough to cover the difference several times over, while the flying operation itself often just barely breaks even or loses money once every cost is counted. Once you see the two businesses clearly, a strange, uncomfortable question follows naturally. If one of these businesses is dramatically more profitable and far less risky than the other, which one is actually running the show behind the scenes? Nothing answered that question more clearly than the spring of 2020. The pandemic grounded almost the entire commercial airline industry at once. Airplanes, the actual physical core of the airline business, became almost worthless overnight as collateral, since nobody was lending serious money against a fleet of jets that legally could not fly, sitting parked wingtip to wingtip in the desert, while the airlines that owned them burned through cash just keeping them insured. So, airlines did something that would have sounded bizarre a decade earlier. They went to Wall Street and mortgaged their rewards programs instead of their planes. United pledged its MileagePlus program as collateral, and eventually raised roughly $6.8 billion in bonds and loans secured against it. Banks and rating agencies treated the deal less like a corporate loan and more like a completely separate business being spun off and pledged as an asset. As part of putting that deal together, United had to formally document exactly how valuable the loyalty program actually was, opening its books to a level of scrutiny a marketing department never expects to face. The number that came out of that exercise was almost unbelievable. Company estimates valued MileagePlus alone at somewhere between $20 and $22 billion. At the depth of the pandemic crash, that was worth more than United Airlines' entire stock market value as a company. Read that again slowly, because it is the whole story in one sentence. The loyalty program bolted onto the side of the airline was, for a stretch of time, worth more than the airline itself. Planes, gates, and all. Sit with that for a moment before moving on. Wall Street was, quite literally, betting more on the app in your pocket than on the fleet parked outside. Delta did the same thing, mortgaging its SkyMiles program for as much as $6.5 billion, later extending that figure toward $9 billion as the crisis dragged on, while burning through tens of millions of dollars in cash every single day just to keep the lights on. American Airlines followed with roughly $7.5 billion raised against its own AAdvantage program. 3 separate airlines, 3 separate emergencies, 3 nearly identical decisions, all pointing the same direction. None of these companies were borrowing against their runways, their gates, or their planes as the primary collateral. Not because those assets were worthless, because the loyalty programs were, by that point, the more bankable business. Credit rating agencies took notice too, changing how they evaluated airline creditworthiness afterward, since a company's frequent flyer program had just proven in the middle of the worst crisis the industry had ever faced, that it could behave like senior secured collateral in its own right, ranked ahead of the airline's regular corporate debt in a bankruptcy. Think about what that actually implies. In a genuine worst-case scenario, airplanes sitting on a tarmac, unable to fly, generate exactly 0 revenue. A loyalty program, so long as people are still buying groceries and gas on a co-branded card, keeps generating cash the entire time. The rewards app on your phone survived the pandemic in noticeably better shape than the actual airline attached to it. Wall Street's own lending decisions are the clearest possible proof of which business the smart money actually trusted. Once you know that, a handful of strange, previously confusing airline decisions suddenly make perfect sense. Take Delta's premium cabin. Back in 2011, the airline sold tickets for only about 14% of its available first-class seats, meaning the vast majority of those seats were being handed out as mileage upgrades and award redemptions to loyal flyers. By recent years, that number had flipped almost completely, with Delta selling tickets for somewhere around 88% of its first-class seats outright. On the surface, that looks like an airline getting more popular in its premium cabin. Economically, it looks like something else entirely. Every first-class seat sold for cash instead of miles is a seat the loyalty program does not have to give away, which makes the miles already sitting in millions of accounts slightly harder to redeem, and slightly more valuable to hold on to, and slightly more likely to just accumulate indefinitely while cardholders keep spending to earn more of them. An airline squeezing its own reward inventory is not an accident. It's a company quietly protecting the profitability of its second business at a small cost to the first one, betting that most cardholders will notice the missing award seat long before they ever question why it disappeared. Ask anyone who has actually tried to book a reward seat lately whether they've felt that shift. The answer is almost always the same complaint. Award availability on the exact routes and dates people actually want has gotten noticeably harder to find, even as the number of miles sitting in circulation keeps climbing year after year, fed by all that everyday credit card spending. More miles chasing fewer available seats is not a coincidence. It is the direct, predictable result of an airline that makes more money selling that same seat for cash than it does letting a loyal cardholder redeem it for free. The frustration millions of flyers feel scrolling through a mostly empty list of reward flights is not a customer service failure. It is the visible symptom of exactly which business the airline has quietly decided to protect. Or take the more recent change to how Delta measures loyalty itself. For years, the entire point of a frequent flyer program was right there in the name. Fly frequently, get treated better for it. Status was earned in the air, mile by mile, seat by seat. Delta recently restructured its own program so that status is now determined purely by how much money a member spends, whether on Delta flights or on Delta's co-branded credit cards. Actual miles flown no longer factor into status at all. American Airlines has pushed the same logic even further, reportedly awarding its own top loyalty tier to customers who have never once set foot on one of its planes, qualifying purely through card spending instead. A road warrior who flies constantly but books the cheapest possible economy fare can now be outranked by someone who barely flies at all, but puts an enormous amount of ordinary spending through the right piece of plastic. Frequent flyer used to mean someone who flew often. Increasingly, at the very top of these programs, it just means someone who spends often on almost anything, as long as the receipt says the right bank's name on it. All of which explains why airlines have fought so hard, so publicly, over a piece of legislation most passengers have never heard of. A bill called the Credit Card Competition Act, pushed for years by Senator Dick Durbin, and picking up real momentum again in 2026, would force big banks to offer competing networks for processing card transactions, letting merchants route payments through whichever network charges the lowest fee. The direct target is the interchange fee itself, the same fee quietly funding the entire loyalty economy. One widely cited estimate suggests the bill could cut those fees by as much as 40%. Airlines for America, the industry's own lobbying group, has organized an entire public campaign around opposing it, warning that slashing interchange revenue would gut the rewards programs travelers have come to expect. That is, in plain language, an airline industry telling Congress, out loud, that a meaningful share of its business depends on a swipe fee charged to a coffee shop having nothing to do with anyone boarding a plane. Supporters of the bill point to what happened when similar limits were placed on debit card fees years earlier. Most debit card rewards programs simply disappeared overnight once the fee funding them dried up. They argue credit card rewards could follow the same path. On the other side, Durbin has separately pushed something called the Protect Your Points Act, which would force airlines to give members a full year of notice before devaluing miles or changing redemption rules, and would stop miles from expiring at all, treating them less like a marketing gimmick and more like a financial product consumers deserve real protection around. Whichever version of that regulatory fight eventually wins, both bills are aimed at the exact same target. Everyone in Washington arguing about it already understands what this script has been building toward the whole time. The loyalty program is not a rewards app bolted onto an airline. It is a financial product large enough that changing one number in its plumbing is treated as a genuine threat to an entire industry's survival. None of this makes the flying business worthless. It's worth being fair about that. A loyalty program with no airline attached to it would collapse instantly. The miles only have value because there are still planes to redeem them on, seats to upgrade into, lounges to sit in before a flight. A bank cannot sell a mile that redeems for nothing, and an airline with no planes in the sky is not an airline anyone would bother partnering with in the first place. But the flying business increasingly behaves like the physical stage a much more profitable performance gets to happen on top of, rather than the star of the show itself. The planes are the venue. The card business is closer to the box office. And box office receipts, as any theater owner will tell you, are usually where the real money actually sits. That distinction matters enormously if you are the one deciding how a major airline should actually be run. It explains a lot of decisions that otherwise look strange from the outside. Why an airline would rather quietly limit how many seats it hands out for miles. Why it keeps signing longer and richer credit card agreements instead of simply raising ticket prices. Why a program built to reward frequent flying eventually stopped counting flying as the main qualification at all. Why an entire industry would organize a public lobbying campaign over a swipe fee bill most of its own passengers will never read a single word about. Every one of those choices makes far more sense once you accept that the loyalty program is not a marketing department bolted onto an airline. In a lot of these companies, it has quietly become the actual center of gravity, with the airplanes rearranged around it. So the next time you tap a co-branded travel card to pay for something that has nothing to do with an airport, a coffee, a tank of gas, a weekly grocery run, remember what is actually happening in that instant. You are not simply collecting a small thank you gift from an airline that likes your business. You are participating in a financial transaction between a bank and an airline that has almost nothing to do with flying. One that was, for a stretch during the worst crisis in aviation history, considered more valuable than the airplanes themselves. One that members of Congress are right now fighting over precisely because everyone involved already knows exactly how much money is quietly moving through it. You never needed to sit in one of their seats for the company to make money off you. You only ever needed to keep the card in your wallet and use it exactly the way anyone uses a card. At a coffee shop, a grocery store, a gas station, nowhere near a single airplane. That was always the actual business model. The flights were just the reason you agreed to carry the card in the first place.